Hello, and welcome back. Today, we're diving into put options. If you're interested in profiting from falling stock prices, this video is for you. A put option gives you the right, but not the obligation, to sell a stock at a predetermined price, known as the strike price, before the option expires. Here's how it works. Suppose you believe stock ABC, currently priced at $50, will fall. You buy a put option with a strike price of $45, expiring in 1 month. If the stock price drops below $45, you can sell the stock at $45, even if it's trading lower in the market. Let's take an example. If ABC falls to $30, you can sell it at $45, resulting in a $15 profit per share, minus the premium paid for the option. If the premium was $2 per share, your net profit is $13 per share. If the stock doesn't fall below $45, your option expires worthless and you lose the premium. This is the maximum loss when buying put options, making it a defined risk strategy. Put options are an excellent tool for hedging. If you own a stock and fear it may decline, buying a put option can help offset potential losses. That's a quick overview of put options. If you found this video helpful, please like, subscribe, and share it with others. Stay tuned for more trading insights. Happy investing!